Hey guys, welcome to Loanable Funds Part 2. In this episode, we are talking about government crowd-out. Now, as you may know already, what we're about to talk about is something that can happen, but it's not something that always happens. There's a lot of extra complicating factors, which I will allude to near the end. So here's our general idea. So how much savings is in the market? We're going to say there's something called national savings, which is equal to private savings plus public savings. And this public savings is savings from the government. If the government decides to borrow money, which is something that we also call a deficit, if the government runs a deficit and has to borrow money, that is a decrease in public savings, which means if public savings goes down, then national savings goes down. Now, what's that going to do in our market? Well, if national savings falls, that's going to affect how much savings are in the market. So let's take a look at this graph again. Here in our original condition, we'll have this is your savings or investment, whichever, because they're the same, doesn't matter. S and I 1. And here's your first interest rate. Then we decrease the supply of loanable funds. We'll just call it S with a deficit. And at this new supply curve, there's a new equilibrium, which has an S and an I2. And it has a higher interest rate. Now, here's the problem with this, okay? When the interest rate goes up, investment goes down. When investment goes down, then your capital per worker goes down. There's going to be less capital in the economy. When that happens, there's going to be less growth. So really, this interest rate change can actually lead to a bad long-run outcome where you actually decrease the growth rate, which can have very big ramifications for a long time. So if this is a problem, like if this graph is accurately representing the situation, then this is a problem. So let's talk about, at least a little bit, when it may or may not be a problem. During an economic boom or expansion, or near the peak of the business cycle, when everything is running and the economy is heated, this crowd out might be a real thing. Because any interactions in this market, if you decrease the supply curve, there's not much wiggle room. The prices are going to rise. But sometimes a market will have more slack. And this is usually true during economic downturns, during recessions, and during bad times, where the market's already really sluggish and has a lot of flexibility in it. If the government borrows money, that doesn't necessarily push up the interest rate. And so, although crowd out is a real potential problem, it isn't always a problem. Plus, we also have the Federal Reserve that's getting involved in manipulating interest rates anyway. And so there's more confounding factors there. This is something we should be concerned about. It does mean that if the government borrows too much money, we actually might see less growth in our economy. And that's something for us to pay attention to. So I hope this is a good intro. If not, too bad, but thanks for watching anyway. You guys, good luck and happy econing.